This is Richard Flax at MoneyFarm with our regular monthly update. After a couple of strong months in September and October, equities took a bit of a breather in November, closing the month slightly down. Global bonds, in contrast, eked out a small gain, while gold rallied. Within equities, the UK and Europe were slightly positive in sterling terms, while emerging markets in the US ended the month lower. Artificial intelligence remained the focus for investors, amid ongoing concerns about a possible AI bubble. Nvidia reported strong results and gave a confident assessment on the outlook for its products, but that didn't completely calm investors' nerves. Measures of market risk, the so-called VIX Volatility Index, rose over the course of the month. We still see robust earnings within the tech space, but continue to watch for signs of overexuberance. It's worth noting that emerging market equities also declined along with the Nasdaq in November. EM equities have performed well this year and we've maintained our exposure there. But we continue to debate just how much diversification EM equities will provide. IT comprises around 20% of the EM universe, slightly below the 32% in the S&P 500. In Europe, in contrast, the weight of information technology is around 8%. Emerging markets do provide geographic exposure, but they remain a key part of the global technology supply chain. In the US, the government reopened following the longest shutdown in recent history, and began to release some of the macro data that had been delayed. The overall picture remains mixed, with weaker than expected retail sales and stronger than expected employment figures. That left investors unclear about the next move from the US Central Bank. But a number of central bankers have subsequently come out arguing in favour of a rate cut at the next meeting in mid-December. The debate seems quite finely balanced, but we think that the Fed will cut rates once more this year. In the UK, all eyes were on the budget in November. The weeks leading up to the announcement were a bit of a circus, with endless rumours and then an early leak of the report from the Office of Budgetary Responsibility. In the end, the Chancellor raised taxes, but perhaps by less than some had feared, and increased spending by enough to placate her backbench MPs, at least for now. The market response proved to be quite muted, with bond yields falling a little. After months of speculation and a difficult fiscal position, a quiet market reaction goes down as a win for the government. In terms of data points, one number that caught our attention last month was 26%, the difference in the share price performance between Alphabet, the parent company for Google, and Nvidia last month. Nvidia has been the poster child for the AI revolution, but it's not the only player. Other large tech companies continue to invest aggressively as both customers and competitors. And it's a reminder that while the AI theme is likely to stay with us for some time, we shouldn't expect to see a uniform response from stocks, even in the same sector. We've had a lot of questions on the UK budget recently. Was the budget good? Was it sensible? And so on. We think there are a few points to make. First, the Chancellor found herself in a difficult situation, with a high starting tax burden, weak growth, and pressure from her MPs to increase spending. Second, the endless leaks and trial balloons gave the impression of a government adrift, which isn't a great look, particularly in a post-Liz Truss world. In the end, the combination of increased taxes and higher spending was enough to placate both the bond market and Labour MPs. And for that alone, the Chancellor can feel relieved. But the long-term outlook looks more challenging. The Chancellor had already identified growth as critical to her economic plans, but there wasn't much encouragement in this year's budget. A high tax burden doesn't usually encourage growth, and according to official estimates, we're looking at the highest level of tax revenues to GDP in more than 40 years. Let's hope for a bit more focus on growth as we head into 2026. Thank you for listening, and look forward to speaking to you again soon.